If you're retired and you think your bank account is private, just sitting there quietly between you and your bank, I need to stop you right there, because that is not how this works anymore. Right now, today, there are systems running in the background of your checking account, your savings account, and even that small CD you forgot about. And those systems are built specifically to flag things the IRS wants to know about. Most retirees never find out about this until a letter shows up in the mailbox, and by then it is too late to do anything but worry. So in the next few minutes, I'm going to walk you through 7 things the IRS is actively watching for in retiree bank accounts. And I am going to save the strangest one for last because it is the one almost nobody talks about, and it might be happening to you right now without your bank ever saying a word. Before we get into it, if you are new here, welcome to Finn Whitfield. This channel exists for one reason: to take confusing financial and tax rules and explain them in plain English, the way a friend would explain them over coffee, not the way a lawyer would explain them in a contract. If that sounds useful to you, go ahead and hit subscribe right now because we publish videos like this every single week, and you do not want to miss the next one. Now let's get into it. Picture a retired guy named Walter. Walter spent 30 years driving a delivery truck, and now he is 68. Collecting Social Security, pulling a little from his 401k, and living a quiet life out in the suburbs with his wife. He pays his bills on time, he balances his checkbook out of habit even though almost nobody does that anymore, and if you asked him whether the government was watching his bank account, he would probably laugh and say there is nothing in there worth watching. Walter is not a criminal. Walter is not hiding anything. But Walter has no idea that his bank account is being watched in ways he never agreed to and never signed up for. And here is the thing: Walter is not unusual. Walter is basically every retiree in America, the kind of person these systems were never designed to catch, and yet gets swept into them anyway, simply because money moved in a way that looked a little different from the month before. So let's break down exactly what is being tracked, starting with the most obvious one and working our way to the one that catches people completely off guard. The first thing on this list is large cash transactions, specifically anything that gets close to $10,000. This number has been baked into banking law since the 1970s, back when Congress passed the Bank Secrecy Act, and it has not changed since. If you walk into a bank and deposit $10,000 or more in cash in a single day, your bank is legally required to file something called a currency transaction report. This goes to a part of the Treasury Department called FinCEN, and it includes your name, your Social Security number, and details about the transaction. Now, here is what surprises people. This is not optional for the bank. It does not matter if you are the most honest person on earth. It does not matter if that cash came from selling your late husband's coin collection or cashing out a CD at a different bank. Once that $10,000 line gets crossed in cash, the report gets filed automatically, often without a teller even mentioning it to you. Most of the time, this report just sits in a government database and nothing happens. But it exists, it is permanent, and it can become part of a bigger picture if other red flags start piling up. And it is worth knowing that this rule is not limited to deposits at your home branch. The same threshold applies to withdrawals, to cashier's checks and money orders bought with cash, and even to certain large purchases made with physical currency, like a used car or a piece of jewelry. International wire transfers carry their own version of this scrutiny too, with banks keeping enhanced records on anything crossing $10,000 and basic records starting as low as $3,000. So if you are planning to deposit a large cash amount, whether it is from selling a vehicle, cashing out a savings bond, or clearing out a safe deposit box you have not opened in years, just know that the system already knows before you even leave the building, and there is genuinely nothing wrong with that, as long as the money is exactly what it appears to be. Now here is where things get more serious, and this is the second red flag, something called structuring. Let's go back to Walter for a second. Suppose Walter sells an old truck for $12,000 in cash, and someone, maybe a well-meaning relative, tells him, "Hey, just deposit $9,000 one day and $3,000 the next. That way you avoid the paperwork." This sounds like smart, harmless advice. It is actually one of the worst pieces of financial advice anyone could give a retiree, because breaking up deposits specifically to dodge that $10,000 reporting line is its own federal offense, regardless of whether the underlying money is completely legitimate. It is called structuring, and it does not require you to be hiding drug money or running a scheme. The law cares about the pattern of avoidance itself, not just the money behind it. Banks have automated systems built to catch exactly this kind of behavior. Smaller deposits spaced a few days apart that add up suspiciously close to that threshold, and these patterns often get flagged faster than a single large deposit would. So if anyone ever tells you to split up a deposit to stay under the radar, that is the moment to politely ignore them, because trying to avoid attention is precisely what draws it. The consequences here are not theoretical either. Structuring charges can carry the possibility of fines and even prison time, and in some cases the money involved can be seized through civil forfeiture before a person ever gets the chance to explain themselves in court. Now imagine a slightly different version of Walter's story, where his daughter helps him sell some inherited jewelry for $18,000, and instead of depositing it in one trip, she suggests spreading it across 4 separate visits over 2 weeks, just to keep things simple. To her, it feels like good organization. To a bank's monitoring software, it looks identical to someone deliberately trying to stay invisible. And that pattern alone, even with perfectly legal money behind it, is enough to generate a federal report. The lesson here is simple. Deposit large amounts the normal way, in however many trips make sense for you, and never let the size of the reporting threshold dictate how you handle your own money. If a bank teller ever asks where a large deposit came from, that question is not an accusation. It is part of routine compliance, and answering it honestly and simply, with documentation if you have it, closes the matter far faster than getting defensive ever would. The third item on this list is something most retirees do not think applies to them, until it does, and that is foreign bank accounts. Maybe you have family overseas. Maybe you inherited a small account in another country years ago and never closed it. Or maybe you spent time working abroad earlier in life and left a modest balance sitting in a foreign bank. Here is the rule almost nobody learns until they are already in trouble. If the combined value of your foreign financial accounts goes above $10,000 at any point during the year, even for a single day, you are required to file something called an FBAR, which stands for Report of Foreign Bank and Financial Accounts. This is filed separately from your regular tax return, directly with the Treasury's Financial Crimes Unit, and the deadlines and rules around it are strict. The scary part is the penalty structure. If you simply forgot what the law calls a non-willful violation, the penalty can run into the tens of thousands of dollars per account per year. And if the failure looks intentional, the willful penalty climbs even higher, potentially half the account balance or more, plus the possibility of criminal referral. This is one of those rules that exists quietly in the background until a retiree with one small, forgotten account abroad gets a notice that turns their stomach. If you have any account outside the United States, even something modest from decades ago, this is worth checking on immediately, not someday. There is also a related form many retirees have never heard of, Form 8938, which kicks in at higher balances and covers a wider range of foreign assets beyond just bank accounts, including foreign stocks and certain trusts, and depending on your situation, you might actually owe both forms at the same time, one filed with the Treasury and one filed directly with your tax return. And here is the part that surprises people most. The days of assuming a foreign account is invisible to the United States are long gone. Thanks to information sharing agreements between the IRS and banks around the world, foreign financial institutions now routinely report account information on American citizens directly back to the United States. That small account Walter's late wife opened decades ago while working overseas is not hidden anymore. It shows up on the IRS's radar the same way a domestic account would. And this is exactly the kind of rule that trips up retirees specifically, because younger workers tend to close out foreign accounts quickly when they move on with their careers, while retirees are far more likely to be holding on to an old account from a job decades in the past, an inheritance from a relative who lived abroad, or property-related savings tucked away in a country they once called home, all without realizing a filing requirement quietly attached itself to that balance years ago and never went away. Number 4 on our list connects directly to something almost every retiree deals with, required minimum distributions, or RMDs. If you have a traditional IRA or an old 401k, the IRS does not let that money sit forever without being taxed. Depending on when you were born, you are required to start pulling a minimum amount out every year, currently starting at age 73 for people born between 1951 and 1959, and age 75 for those born in 1960 or later. Here is how the IRS keeps track of whether you are actually doing this. Every time you take money out of a retirement account, the company holding that account sends you and the IRS a form called a 1099-R. The IRS then matches that form against what your account is supposed to have distributed for the year, based on your age and your account balance from the previous December. If the numbers do not line up, if you withdrew too little, withdrew late, or skipped a year entirely, that mismatch gets flagged in the system. The financial consequence is real too. Missing or shorting your RMD can trigger a penalty equal to 25% of the amount you should have taken out, though that penalty can drop to 10% if you correct the mistake within 2 years. Picture Walter again, distracted during a rough year, maybe dealing with a health scare, who simply forgets to take his distribution on time. The IRS does not see the rough year. It sees a number that does not match the form, and that mismatch is enough to trigger a closer look. Let's put real numbers on this so it sticks. Say Walter's required distribution for the year was $8,000, and life got in the way and he never took it. Under current rules, he would owe a penalty of 25% of that missed amount, which works out to $2,000, on top of the regular income tax he still owes once the distribution is eventually taken. Fix it within 2 years and that penalty drops to 10% instead, but plenty of retirees never even realize there is a clock running until the notice arrives. There is also a timing trap worth knowing about. The very first RMD can be delayed until April of the following year, but doing that means 2 distributions land in the same calendar year, which can quietly push someone into a higher tax bracket without them ever intending to spend more or earn more. On a more positive note, retirees who are charitably inclined can sometimes redirect a chunk of their RMD straight to a qualifying charity through something called a qualified charitable distribution, which can satisfy the requirement without adding to taxable income at all. But that is a strategy to discuss with a tax professional, not something to attempt without guidance. The 5th thing on this list involves something most people consider completely personal: gift giving. And this is where a lot of well-meaning retirees accidentally raise flags they never intended to raise. Let's say Walter wants to help his granddaughter with a down payment, or wants to give each of his 3 kids some money while he is still around to see them enjoy it. The IRS allows an annual gift exclusion, currently $19,000 per recipient, or $38,000 total if a married couple combines their exclusions for one person. Go above that amount to any single person in a calendar year, and you are technically required to file a gift tax return, even though in the vast majority of cases no actual tax gets paid, thanks to a lifetime exemption sitting at $15 million per individual right now. So filing the form does not usually mean owing money. But here is the part that catches retirees off guard. When a retiree with modest reported income on paper suddenly starts moving large or frequent gifts out of their account, amounts that do not seem to match their known income from Social Security and small pension payments, that pattern can draw attention on its own. It is not that gift giving is wrong, it absolutely is not. It is that unexplained money movement that does not match a person's documented financial picture is exactly the kind of inconsistency these systems are built to notice. Think about it from the outside looking in for a second. If Walter's bank statements show Social Security and a modest pension as his only income, and then suddenly $40,000 moves out of his account to 4 different people within a single month, that is a noticeable jump even if every single dollar of it is a completely legitimate, loving gift to his kids and grandkids. Filing Form 709 in that situation does not usually cost Walter anything because he is nowhere near using up his $15 million lifetime exemption. But the form still needs to be filed once any individual gift crosses that $19,000 line for the year, and skipping that paperwork, even when no tax is ultimately owed, is itself a compliance gap the IRS can flag later. Number 6 is closely related but a little broader, and it covers sudden spikes or shifts in account activity generally, beyond just gifts. Maybe an account that has been quiet for years suddenly receives several large transfers in a short window. Maybe money starts moving back and forth between 2 or 3 accounts in a pattern that looks unusual, compared to a retiree's normal, steady routine of a Social Security deposit and a few bill payments each month. Banks build behavioral profiles around accounts over time, almost like a fingerprint of how that account normally behaves. When the pattern breaks sharply, even for reasons that are completely innocent, like selling a house, settling an estate, or consolidating accounts after a spouse passes away, that shift can stand out. None of this means you are in trouble. It simply means the activity gets logged and, in some cases, reviewed by a human being on the other end, especially if it lines up with other unusual signals happening at the same time. Think about what happens after a spouse passes away, something so many retirees go through. Suddenly there might be a life insurance payout landing in the account, transfers from a jointly held account being consolidated, maybe proceeds from selling the family home a few months later. Every single one of these events is completely ordinary and explainable, but stacked together within a short window, they can make a previously quiet, predictable account look like it transformed overnight. Banks are not trying to make grief harder, but their systems do not know the difference between a suspicious pattern and a deeply human one. They just see numbers that broke from the routine, and that is often enough to trigger a closer look or an internal review on the bank's side. 6 down, 1 to go, and I genuinely mean it when I say this last one is the reason I wanted to make this video in the first place. Everything we have covered so far at least has some kind of visible trigger attached to it, a number you could look up, a form you could ask about, a threshold you could plan around. What comes next does not work that way at all, and once you understand it, you will probably never look at a simple bank deposit the same way again. And now, here is the one I promised you. The red flag almost nobody knows is happening, even though it is happening constantly, all across the country, in accounts belonging to ordinary retirees just like Walter. It is called a Suspicious Activity Report, or SAR. And unlike the currency transaction report we talked about earlier, this one does not require any specific dollar amount to trigger it. None. A bank can file a SAR over a transaction of $500 if something about it feels inconsistent with how the account normally behaves. And here is the part that genuinely surprises people. By law, the bank is prohibited from telling you that they filed it. You will never get a notice, a phone call, or so much as a hint from your teller that a report went out with your name on it. It sits quietly with financial crime investigators, and it can be combined with other reports, other patterns, and other flags from this very list, slowly building a profile, all without your knowledge. What actually triggers one of these reports varies wildly, and that is part of what makes this so unsettling. It could be a series of withdrawals just under a round number, repeated for several weeks in a row. It could be an elderly account holder suddenly making transfers to an unfamiliar name, which, to be fair, is also one of the ways banks try to catch elder financial abuse and scams targeting retirees. So this layer of monitoring is a double-edged sword. It protects people just as often as it simply observes them. It could even be something as mundane as a retiree withdrawing cash from several different branches of the same bank within a short period. Most SARs lead absolutely nowhere. The vast majority involve nothing illegal at all, but the fact that this entire reporting layer exists, completely invisible to the account holder, is something almost no retiree learns about until they stumble across an article like this one, or a much harder lesson involving a stack of mail from the IRS. So let's bring this all together, because once you see these 7 things side by side, the picture becomes pretty clear. Large cash transactions near $10,000 trigger automatic reporting. Splitting deposits to dodge that threshold is its own federal violation, regardless of intent. Foreign accounts above $10,000 combined require a separate filing with serious penalties for skipping it. Required minimum distributions get cross-checked through 1099-R forms every single year, with real financial penalties for falling short. Gifts that do not match a retiree's known income can draw quiet scrutiny even when no tax is ever owed. Broader spikes or shifts in account behavior get logged and sometimes reviewed by real people. And underneath all of it, banks can file invisible suspicious activity reports on any transaction, at any dollar amount, without ever telling the account holder. None of this means the IRS is hunting down retirees, and none of this means you have done something wrong simply by having a bank account that behaves like a normal human bank account does, with ups and downs, gifts to grandkids, the occasional large cash sale, or a year where life got complicated and a distribution got delayed. The vast majority of these reports lead nowhere at all. What this video is really about is awareness, because knowing these 7 triggers exist means you can avoid unnecessary confusion, unnecessary stress, and in some cases, an unnecessary letter in the mailbox that takes months to sort out and even longer to stop thinking about. I will say this clearly before we wrap up. Everything you just heard is general information meant to help you understand how the system works. It is not personalized tax advice for your specific situation. And if any of these 7 points genuinely apply to you, the smartest move is a short conversation with a tax professional who can look at your actual numbers and your actual accounts and tell you exactly where you stand. Now, before you go, I want to know something from you, and I genuinely read these comments. So scroll down and tell me, out of these 7, which one surprised you the most? Was it the structuring rule, the forgotten foreign account, or that hidden suspicious activity report nobody tells you about? Drop it in the comments, because your answer might be exactly what convinces someone else watching this to double-check their own accounts before a small oversight turns into a bigger headache. And if you know someone, a parent, a neighbor, a friend from church, who is retired and has absolutely no idea any of this exists, do them a favor and share this video with them right now, this very minute, before you scroll past it and forget. This is exactly the kind of thing that is far easier to fix before it becomes a problem than after, and a 30-second share could save someone you care about a genuinely stressful year. If this video helped clear things up even a little, hit that subscribe button if you haven't already, because we are covering Social Security traps, Medicare surprises, and tax mistakes retirees make every single week right here on this channel, and you will not want to miss what is coming next. Thanks for spending this time with me. Take care of yourselves out there, and I will see you in the next one.